Good morning, Futex traders, and welcome to this weekly roadmap for Futex Live. This is Brannigan filling in for Milto today. Very briefly, our focus points for today, we're going to just quickly have a look at the weekly calendar and the risk events for the week. We're then going to just summarize the previous week again, like we did on Friday, sort of get an understanding of what actually happened over the course of, the 5 trading days last week. And then we're going to talk about some of the markets on the move, being the emerging markets, the oil and the US bond curve, and try and get an idea as to, where the opportunities are going to come from this week. So straight into it, and let's have a look at the weekly calendar. Very important this week, as you can see, starting on Monday today, we've got the UK PMI services and the US ISM non-manufacturing. So again, on Thursday last week, we had, a few of the data pieces, the PMIs coming out, the manufacturing type data. And now today and this week, we've got the non-manufacturing, so the services type data. Now, these are both key risk events for today, simply because, right now the world is, talking about growth, deflation, all these sort of concepts are on the tips of tongues of many investors out there. So, any kind of outlier, very strong numbers or very weak numbers in the PMIs, the services PMIs today, could obviously be market moving. Then on to Tuesday, we've got the all-important RBA rate decision. Again, it is a key event for the week, simply because a lot of people are saying that we haven't quite found a bottom yet in terms of the rate cutting cycle for the RBA. So keep a close eye on that. We also then do have the ECB's Draghi speaking on Tuesday. Now, the topic of his discussion is not yet finalized. However, again, the market is trying to find any kind of, lead on as to whether the ECB is likely to do further QE, or at least increase their pace of purchases into the back end of the year. Then on Wednesday, we've got the Japanese rate decision and UK manufacturing production data, as well as the US oil inventories. Now, just with regards to Japan, guys, key event for anyone trading yen. If not this meeting, they have been tipped to pick up the pace of quantitative easing purchases in the month of October. JP Morgan came out last week and said that this week, Wednesday, could be the day that they actually do decide to pick it up. So crucial meeting, make sure you're in for that. It will be a market mover. It will, if they pick up the purchases, it's going to have a risk on spillover effect into the European session. So key day Wednesday, keep a close eye on that. And then Thursday, we've got the Bank of England rate decision. Just remember, obviously, the Bank of England has now changed their structure. They released the the rate decision as well as the minutes all at the same time. We are at the point now of an 8-1 structure, with 2 of the members very close to changing their stance. Whilst it's unlikely we see a change in the vote this week, don't forget that the Bank of England is, with the wage growth pressure currently, there are a few members that are sort of on the edge of changing their vote. As well as then we've got the all-important highlight of the week, which is the Fed minutes on Thursday. Now, so important, guys. It's an absolute crucial meeting. It's almost a meeting in which we could find out how much, how close we were actually in December to a potential rate hike. If, right now the market is very, very dovishly priced against, what the Fed is telling us. The Fed continues this sort of rhetoric of we're going to hike this year, yet they've not really given any kind of a firm signal as to when that could be, whether October or December. So very crucial. Pay close attention to the minutes on Thursday. It's going to be a volatile one. The market is particularly sensitive now to rate hikes. And then obviously Friday, no major or a lot of secondary data, but nothing really in terms of risk. What I would say is, don't forget, next Monday is a US bank holiday. It's the Columbus Day, I think. So a lot of people with a lack of data, lack of risk drivers on Friday will probably take a long weekend. And then as a recommendation, I would say, if you make some money early on in the European session, take a long weekend yourself too. Enjoy the time off accordingly. So, and as you can see, obviously, we've allocated our risk for the week. Thursday, Wednesday, Thursday being the highlights of the week. So, just come in with some sort of an idea as to how you're going to allocate your risk going over the week. So that's effectively the weekly calendar. Let's then turn our attention to the week that was and just try and summarize what we actually saw last week. Now, very important, as you can see, the highlights, the equity markets, both the US and European, these are good barometers. We can see they were both nicely, just a solid up week. We have seen, since the Black Monday, we've seen the equity markets, in this sort of continuous bad sentiment type mode, and it didn't help with the VW story and obviously the Glencore story. But in essence, the week started off very, very bearish, and equities were very well offered, and there was very weak sentiment in the market. Yet we closed the week up. So that's the important thing, an important statistic to look at. Whilst it felt weak on the week, we did close the week up. So that's important. In terms of the some of the dollar pairings, the euro dollar, as you can see, mostly flat on the week. The yen mostly flat on the week. So again, very, very flat week. What I would say is, we did see a little bit of dollar sell side action on the NFP, and as a result, that's probably why we saw just the dollar close slightly down on the week. So as you can see, the dollar index marginally lower, nothing really worth getting too excited about. And what's important to note there is, if you look at how the dollar moved on Friday from the NFP, we actually didn't even close that far down. So, the dollar continues this theme of, bad news, good news, doesn't really matter. We're just going to keep buying dollars. So, obviously keep that in the back of your mind. There is a very big long position in the dollar, waiting for that final signal from the Fed as to when we're going to lift off. The important markets this week, obviously the bonds. Okay, we had very, very aggressive moves in the bonds. Most of the volatility was in the bonds this week. They are the highlight of last week, and we will talk about that a little bit further down the page as to some opportunities. Other than that, oil, as you can see, marginally down again, $1. And we will talk about that oil chart in a minute. And then gold was down, quite a lot on the week, down 3.25%. Probably one of the few commodities that was actually quite aggressively down on the week. So that's the week in a nutshell. And it was all about the bonds last week. Most of the markets were relatively sideways. There was a lot of chop and change in terms of direction, but the bonds were very much in a firm uptrend for most of the week. So important to understand that, because when we analyze a little bit further down, it will give us some clues for this week. So let's turn our attention then to the markets that are, the interesting markets. Now, I want to start off today with the emerging markets, particularly because we've seen some relatively aggressive price action in the emerging markets. And, just keeping that in the back of the mind could help us over the course of the week. So the first two we got here on the left, we've got the Turkish lira. And on the right, we've got the Indian rupee. Now, as you can see, this Turkish lira as a weekly candle, sort of almost had a full-bodied close candle where it opened at the high of the week at the opening price and closed at the low of the week. Now, these tend to sort of almost have continuation type patterns. Now, whilst we're in a firm uptrend, and I'm not suggesting we're going to just suddenly reverse that, it does seem as though we've got a little bit of further downside this week, maybe a little bit more filling in towards the downside in the Turkish lira. A very similar type candle in the Indian rupee, a nice engulfing candle in the week where we opened where we closed, and we closed well below the previous week's low. So a very, very bearish type candle that in the Indian rupee. Let's then look at two more emerging markets. The first one is the Brazilian real. Again, we opened where we closed, and whilst we had a very aggressive up move early on the week, we actually closed lower right at the low of the week. So again, almost a very, very bearish type closing candle on the weekly charts. And then the Mexican peso. Now, we've spoken a lot about using the Mexican peso as a barometer for emerging markets, and interesting enough, it's probably had the price action that's been least reflective of any kind of continuation type pattern. However, we have got a firm inside week. If we can take out last week's lows, it does bring in the previous week's lows as a potential first target, with this then sort of this buy side low that we made back 3 weeks ago. So again, keep an eye on the Mexican peso. It will be a good lead on emerging markets. So all in all, emerging markets looking like further appreciation this week, which should give us a little bit of stability in terms of the commodities, in terms of the global backdrop, in terms of the risk sentiment. Let's then look at the Chinese yuan. Again, not much been spoken about this over the last week, but what I wanted to talk about was this appreciation we saw, in the back end of last week, Tuesday, Wednesday, Thursday, Friday. Just a steady appreciation in the Chinese yuan. Now, if you guys remember when we devalued the Chinese yuan back in, the surprise devaluation, that really did create a lot of weakness in, particularly Chinese and the Asian equities. Now, all I'm going to say is pay attention to this, this low we made back in early September, because if we were to take that out and continue to fill in this depreciation gap, we could well see that give a nice positive boost to the Asian equities, which will then obviously spill over into the European equities. So again, factor that in your morning routines. Make sure you know what the Chinese yuan is doing against the dollar, and also more importantly how the Asian equities are responding as a result. So that's the Chinese yuan. Let's then turn our attention to the WTI oil. Definite market on the move. Reason being, on the break of this weekly trend line, or sorry, this is a daily chart. So the break of this daily trend line at 46.5, we saw a huge surge in volume and volatility. I did show you guys that pattern as a price action setup. If you haven't seen it, it is obviously on the it is loaded up on the Futex Live website. However, go watch that breakout again. There was a lot of shorts stopping out and a lot of longs being initiated there. So very, very important. Again, if we can break above that trend line this week, it's all about that 47.10 area. We take that out and we sustain that, and we're going to see a trend-like move over the course of the next couple of days in the oil market. So that's the key trade, 47.09. The break of that is crucial for anyone who's still holding on to shorts. They will stop out there, and we will get a continued trend up move in the oil. So keep an eye on the oil this week. It does feel ready for a move now. On the upside, obviously, that's our key level. To the downside, however, we've obviously got this rising support, which comes in somewhere around $44 a barrel. So very crucial week for oil, both from a technical landscape and a fundamental landscape. What I would also just point out in terms of the fundamentals, supply and demand, is we're continuing to see this hard stance from the Saudi Arabians, the stance of we can accept oil prices lower for longer. So fundamentally, it still suggests the long-term trend is for further weakness in the oil price. However, in the near term, price action suggests we could either continue with the sideways action or break above or even break below. So be flexible, be nimble, no need to have too much of a bias here, just go with the flow rather than against it. So that's the oil market. And then our US bond curve. Now, this is the highlight of the week, and somewhere where I want to just point out a few trade opportunities for traders. We're going to start off with the US 2-year simply because it is the most interest rate sensitive part of the curve, but also it was the part of the curve that moved the most aggressive last week. The front end of the curve really sold off quite heavily last week. Now, the important backdrop to understand is that we've got the Fed telling us on the one hand that they're going to hike this year, and on the other hand we've got the market's inflation expectations at record all-time lows. So it's almost like the market is saying, well, there is no way you can actually hike rates with inflation expectations at these levels. And they're almost betting it. It feels like we've got a George Soros here where the whole market's betting against the Fed and saying, well, you're lying about actually looking to hike rates this year because you're just not giving any kind of confidence to the market. Now that creates a very interesting backdrop for us because one of two things is going to happen now. Either the market's going to turn out to be right in this situation and the Fed will be wrong and they'll lose credibility, or what we're seeing last week was maybe just a short squeeze where anyone who was playing for that Fed hike by the end of the year is now out of that trade, and the net position in particularly the front end of the curve has turned to a neutral. So there's no longs, no real shorts. There's just maybe some short-term speculative positions in the market. But the important thing to understand is that we held this low somewhere around these 53 basis points, and that has acted as crucial support for most of the September month, or most of the sort of July, August, and September. So what I would say is we are approaching sort of a 4 or 5 month low at these 53 basis points. It did act as good support initially on Friday. I would definitely be looking for that to hold if we're going to turn back around and yields are going to continue rising. However, if we do break that, caution for anyone that's shorting these US bonds. There's obviously something bigger at play in these bond markets, and maybe this deflationary fundamental concern is starting to actually price into the yields of the US bond curve. So that's the 2-year. But more importantly, let's actually pay attention to the 30-year. Now, something I learned a long time ago was when the 30-year leads, you've got to pay attention to the 30-year. And what I want to point out is this is again a weekly chart. I want to point out the comparison between the closing candle in the 30-year and the US 2-year. Now, as you can see, the 2-year closed almost in the bottom quartile of the week's range, whereas the US 30-year almost closed in the top quartile of the range. Now, that is significant, guys, because what we've seen over the course of the last week, and it's why I think US bonds are so crucial to pay attention to, is we've seen some very, very aggressive steepening. Now, if you pay attention to this chart at the bottom here, this line, this is effectively the US 10s 30 curve. And what we can see is over the course of September and the back end of last week, we've seen very, very aggressive steepening. In other words, the 30-year, as prices are going up, is being sold into, whilst the front end of the curve, in this case the 10s, is being bought. So we're seeing this very aggressive steepening type play, which could be a result of obviously maybe a squeeze in the front end of the curve as a result of pricing out anyone who was looking for a rate hike this year. But equally, this is something to pay attention to, the steepening, because it is telling us that in essence the back end of the curve, or at least someone is saying that that the back end of the curve has become too flat, and whether that's because of positioning, or whether that's because there is a firm belief that actually there isn't a deflationary concern in Europe, in the world. It will take time to figure out which it is. But the important thing to point out is that everyone is playing for a very flat back end curve. So just watch out this week. A bit of volatility in the 10s, 30s, maybe 5s, 30s part of the US curve. Again, obviously note this is the 10-year chart. We can see this rising support coming in, and note that the market held on to that and closed above that trend line. So again, early this week, watch for the retest of that trend line. But more important, guys, please note what we saw over the course of last week, this is the daily chart, was 5 very continuous downtrend type candles. Now, what I want to point out is, because of the market's aggressiveness to the downside, it hasn't really had too much time to build in any real resistance in this this down move over the last 2 weeks. So pay attention as prices come back up, particularly to that 2% yield. It has been flagged. We get above there. I wouldn't be looking to short this too aggressively. I'd rather be looking to just go with the flow as the market navigates its way back up towards this 2.2%. So that's the US 10-year. It's presenting some great volatility, but also some significant trading opportunities. All right. Other than that, guys, that we're going to wrap up there. If you have any questions, feel free to send me a tweet or a message on Twitter. Otherwise, good luck for the week. That's our roadmap. Pay attention to the markets that are moving. If something's going with a bit of flow, don't go against it. Go with the flow. All the best for this week, and we'll catch up again next week.